I'm going to summarize some results because we've done a lot of analysis, but once again, this paper is available in the Journal of Portfolio Management. It's coming out in November of this year. So we've done a lot of additional work, but this is a quick summary. So if you look at, we've replicated 12 months, 3 months, and 1 month momentum using daily returns. So 252-day look-back period is roughly 12 months. 63-day look-back period is roughly 3 months, and 21-day look-back period is roughly 1 month. And then we hold either 1 month, which is 21 days, or 5 days, which is roughly 1 week. And we look at two strategies. Panel A shows the strategy that allocates equally across all the instruments. And panel B uses equal risk allocation, just like in the paper by Moskowitz, across all the assets. And what we find, once again, for the most part, trend does well across different asset classes, across different time frames. And in general, volatility targeting does improve performance, except there's one incident when you look at monthly return, and in equities, you can see slightly worse result. But for the most part, volatility targeting does add value. What you can notice here is that when you compare our short-term strategy, which is 21.5, it tends to perform better than a typical 1 month strategy, 21.21, whether it's panel A or panel B. So the hope is that if short-term strategy is actually superior to 1 month, and if correlations are high enough, it could be actually a good substitute for the traditional 1 month strategy.
I see.
And when you look at correlations, you can actually, I mean, of course, correlations are pretty, they're pretty intuitive. For example, you can see that correlation of short-term momentum and 1 month is pretty high, 0.6, and then declines, goes down to 0.21. When you look at correlation of short-term momentum and 12 months momentum, those are very typical patterns. But based on two facts, one is short-term trend tends to perform better than 1 month momentum, and correlations are relatively high. Our hypothesis was, well, it's possible that short-term trend would be a good substitute for the 1 month momentum strategy. So we actually looked at we took a benchmark portfolio that was introduced in Hurst et al. 2017 that gives equal weight to 12 months, 3 months, and 1 month. And then we try to introduce short-term momentum by either taking complete weight of 1 month, which is balanced 1 strategy, or splitting equally the allocation to the 1 month strategy between 1 month and short-term momentum. And the reason why we look at both of those is because we want to be extremely careful with data mining. So we want to see validation in a couple of different implementations. And we ask a few questions. One is performance getting better? And we want to be careful that we consider transaction costs. The second thing is, are we losing the crisis alpha benefit of trend if we introduce short-term trend? And the third question is really inspired by this data mining concern. If we see an improvement, what drives it? We want to understand why short-term trend improves performance of trend strategies. Mm-hmm. So those are 3 key questions we try to answer. And what we found is that before we consider fees, balanced portfolio tend to be superior to the benchmark standard portfolio of Hurst. And you can also see that that happens without correlations, without sacrificing correlation to S&P. They pretty much stay roughly the same, maybe slightly more negative. So we're able to improve performance without sacrificing crisis alpha. And then the question becomes, if that's the case, what's the impact of fees? And we looked at a couple of different versions of fees. We start with some more conservative costs, and we took them from the Hurst paper. And what we found is that if costs are conservative, there's actually no benefit of short-term trends. But we would also argue that even though conservative costs are appropriate for typical strategies, when you look at short-term strategies, typically those managers tend to take execution very seriously. They often use co-located servers. They often use specialized algos to reduce costs. And that's why we also looked at another set of assumptions with more optimistic costs. And what we find that in that case, short-term trend still substantially improves performance of traditional trend strategies. So our conclusion here is short-term trend has the potential to improve performance of trend strategies without sacrificing crisis alpha benefits, but this conclusion highly depends on the quality of execution.
So I wonder, so I look at these results and I say, even at the higher cost expectation level, the adding diversity to your trend signals doesn't hurt, right? The Sharpe ratio is essentially the same, right? You've got 0.1, 7.1, 7.3, 7.4. So it doesn't hurt. And then you sort of lean on some of the literature on ensembles about the fact that the benefit of an ensemble doesn't really show up in the Sharpe ratio, but it does show up in the standard error of terminal wealth. And I think all things equal, if I get the same Sharpe ratio and I get a narrower distribution of terminal wealth because of the ensemble benefits, then even with the higher cost expectations, I think I'd still skew to using the ensemble over than the single specification. Do you have similar intuition there?
No, I think that's exactly right. And I think that, I think in general, I think we believe in diversification. So as I mentioned earlier, in Q1, we saw a great example that it was better to be diversified across timeframes and assets. And I'm a huge believer in ensembles. I'm a huge believer in diversification across parameter sets. So from that perspective, for sure, I do prefer having a more balanced portfolio. And I think that's what sets us apart from most trend and even CTA programs, is that we tend to be much more diversified across different types of managers and across different time frames, across different markets. So we're strong believers in ensembles, and I think you're right that in this case, adding short-term trend does improve diversity across parameters.
Beautiful. So the third question was why, right? Why?
Yes. So you actually looked at, we had two hypotheses, and actually it was really great because Larry knows everybody, so he just emailed Cliff Asness and said, "Hey, Cliff, what do you think about this paper?" And Cliff said, "Oh, let me just talk to my academics." So he actually asked a couple of them, and they gave some really good feedback. And their feedback was, well, maybe it's all driven by the rebalancing effect, because they wrote a paper about that came out in 2014. So we actually looked at that, and what we found that rebalancing did not really add value after transaction costs. So even though there were some significant potential benefits before you consider costs, after transaction costs, there's no benefit. And then we said, okay, so is it possible that performance gets better because of some diversification benefits, right? And what we found, and I'm going to show you the slide, when you look actually at the worst performance for the 12 months strategy, you can see that in the first column you can see there's the 10 worst instances. On average, the strategy was down 7.85%, and on average, neither 3 months or 1 month momentum made money during those periods, right? By contrast, you can see that short-term momentum tends to make money and makes money more consistently than the other strategies. So our conclusion here was that the reason why short-term trend improves performance of trend strategies, because actually it's a really great diversifier to the other strategies, and in particular to the very popular 12 months momentum strategy.
Yeah, so I love it. So if I remember back to the chart where you showed the correlation between the different strategies, I want to say that the correlation between 252.21 and 21.5 was it 0.26 or 0.36?
Yep. Yeah, it was actually 0.2.
Yeah.
Yep. Mm-hmm.
And so that obviously captures some of it. But what I think what I'm seeing here is that actually the correlation, when you just observe returns into tails, may be even lower between the different.
Exactly.
Right. Okay.
That's exactly right. And we actually, the paper has more details on that, because the referee asked us to do it by asset class. So actually we've done it by individual asset class. We looked at 12 worst months in equities to a worse month in fixed income, FX, commodities, and we got very similar results.
Awesome. So I just wanted to back up. And so when the folks at AQR suggested that it might be due to rebalancing, do you mean the rebalancing premium, like gamma scalping, vol harvesting, that kind of stuff, or some other effect?
Well, so they wrote a paper about the impact of rebalancing. And in that paper, they said, well, let's look at monthly rebalancing, weekly rebalancing, and daily rebalancing. And they were actually showing that more frequent rebalancing tends to produce better results. And I don't remember all the details, but my theory is that the reason why rebalancing tends to help is because of better diversification. And it could be here's a very simple example. So let's say I have two investments, and they're very similar. They have the same odds of making money. Let's say it's 50-50. Okay. And let's just say that one of them just happens to be lucky, and the second one just happens to be unlucky, right? So if you don't rebalance between those two, then your expected variance is going to be higher given the same expected return, right? Because you give disproportionately high weight to the first investment that happened to be lucky,
which
right?
compounds.
Whereas if you don't rebalance, but if you rebalance, you get the same expected return, but your variance goes down because you're better diversified across those two investments. Does it make sense? Or
I'm writing a paper on the rebalance premium in futures, specifically for risk parity strategies. And so I'm just wondering to what extent they were leaning on that effect. And I don't know if you saw the new paper. I think it came out of Boston University. Corey Hofstein shared it with me, and I think he just tweeted on it a couple of days ago. But the authors, they introduced a new explanatory variable. So they looked at the Rob Arnott or Research Affiliates fundamental indexing methodology, and they were wondering the degree to which the excess returns were due to the characteristics, like the loadings on value and size and some of the other classic factors, or was it just due to this rebalancing effect? And what they found was that the entire premium was explained by this rebalancing premium. And when you back that out, there was no remaining, the intercept term flattened. And so I was wondering that because there's a lot of an increasing cacophony of discussion about the size of this rebalancing premium, and in an environment where risk-free rates are at 0.5, 0.7 percent or 70 basis points, then a 1% or 2% rebalancing premium is a really substantial boost to expected returns, right? So I think maybe that's
absolutely
some of this research. So I was just wondering whether that's what you for rebalancing variable, but I'm not sure it's exactly the same.
Yeah. So Adam, I know that you think very deeply about lots of different topics, and I know that you and Corey, you guys have done quite a bit of work on rebalancing. You guys know more about it than I do. So in my case, I just compared performance of those strategies. But I think you're definitely thinking more deeply about this issue of rebalancing than I do.
Oh, good. Well, it sounds like something that we can carry on offline with some case examples.